What up, investors? Today I'm going to be talking about Xcel Energy. Xcel Energy is a utility company, and traditionally those are pretty stable in the markets. They are not easily moved by the whims of the economy, and they're usually perceived as a safety trade by most investors. And that is because the revenue is very predictable, and everybody needs energy during the winter and the summer to cool or heat themselves. And for other reasons, people will cut this last on their bills. Everything else goes before that, besides maybe their phone bill and their iPhones. So I'm going to be looking at everything, but I'm going to do a shallow dive. It's not going to be super in depth, although I did some digging into their report, to their 10Q. So I have something that I found out over there that I'll share with you. First of all, we're going to take a look at the price action. This stock has been experiencing quite the rise, and I think mostly since 2018. I guess for a long time, for the last 12 years. I do think that some of that is unsubstantiated, and I'll show you what I mean in a minute. Before we go into that, let's take a more kind of a bird's eye look into the company. I like to look at everything in a visual sense here through stockanalysis.com. We're going to go into the quarterly bars so we can get a better idea of how the business functions. It seems like there's been a very, very flat revenue for the last, 10 years, while we experienced a pretty big rise in stock price. So it makes somebody wonder, why is the stock price rising in the last 10 years if the revenue is the same? Maybe the earnings has gotten better, or they repurchased shares or something like that. So let's find out if that's the case. Let's take a look at the operating income. And operating income has actually been very flat. In fact, it's on a kind of wavy, but it certainly hasn't been growing at the same pace that the stock price is. So perhaps they're repurchasing stocks, right? Well, not exactly. They're actually been issuing more stocks at a very slight rate, so it's almost immaterial. But they have been issuing. They have not been repurchasing stocks. So one thing that has been growing, though, is the dividend. But a growing dividend doesn't mean anything if you don't have the earnings to back it. In fact, it becomes a bit of a liability if you're taking that much money out of the business without having a backing. Currently, the payout, since we're on a dividend wave, currently the payout ratio is 62.8, which is somewhat high, but very much safe at the moment, considering considering the income is very steady and predictable. Their dividend growth is about 6.53% per year. So they're going to be able to pay their dividend for quite a while, but even though they're growing it, it's still only 2.59%, which is lower than a lot of other utilities out there. So there are other stocks, other companies that offer a better yield than this, although it might be less sustainable. Now, that's on the financial front. Let's take a look at some statistics, okay? The company is valued at $40 billion. I'll tell you why I think that's a little bit heated. I think it's a bit overpriced, actually. The main reason is because enterprise value is at $65 billion, so it's really high. The reason for that is, of course, they have $24 billion in debt. Now, I did some digging on this debt. You can see it, net cash here, $24.64 billion. Now, I did some digging on this debt to find out what's going on there, and actually they have got really good creditors. Their rates are really low. They have anywhere between 1 and 1.9% rates, so they're doing great with that. So you don't have to worry about them paying a lot of money in interest, but nevertheless that debt is still in there, and they're going to have to at some point, well, although they don't have to at some point pay it, they could perpetually carry it. But if they have to renew that debt at a higher rate, it's going to really, really, really hurt them. So I don't like the fact that they have 25 billion in debt, which is actually more value that I would assign to the enterprise value of the company. So I do think this stock is actually quite overvalued. by about 2 times. And I'll show you my reasoning, okay? Now, if we let's take some of the statistics here. Look at the enterprise, the PE ratio and the EV over earnings. So the price to earnings ratio is almost 25. And these are steady earnings. It's not like they're experiencing a lower than normal earnings, and this is going to be, corrected in the future. And EV to earnings is 40. 40. So investors are paying quite a bit of money for stability. Yes, this company is stable. Yes, it will still keep making money for as far in the future as we can see, but it's not growing revenue and it's not growing earnings. The only thing that's been growing is their stock price and their valuation. So, in my opinion, this is quite a bit. I think for a utility company, you want these numbers to be quite a bit lower. So, I'm not in favor of the valuation. One of the other reasons that the revenue has been growing is their input costs. So when I was looking at their report, the input costs are higher, right? So the things they have to pay for are a bit higher, not that much, and also they're charging more for their services to kind of offset that. But the net difference isn't really material. They just have similar margins. Maybe let's see if we can find the margins here. We're looking at profit margins. Yeah, look, they've been standing around, around the 10%, 9-10% area for a very, very long time. So the margins are remaining the same, and they're not experiencing an abnormal boost in anything, especially not an abnormal boost that's structural. Any kind of change they experience right now is just basically due to inflation and input costs, and which they're passing on to their consumers, but they're not benefiting from any of it, right? They're just doing business as usual, which we would expect them to do. It is an inflation hedge, especially in a country like the United States, where things are, believe it or not, less subsidized than and interfered with than other countries. I know that in the States here, we think that the government's always messing around with how things function, but there's a lot more free market here than other countries, trust me. So, but in a country like this, the costs from inflation are going to be able to be passed on, and the company will survive and do just as it's been doing up until now. So I'm not really afraid of that, and maybe that's what the investors are really paying for, is the fact that this company will survive. But I'm not really sold on that idea. I think that investors are paying way too much at a 40 billion market cap. When I did my own estimation and calculation, I got about excluding the debt, so I got an EV value of like maybe 25 billion, and the enterprise value of this is 65. So I would buy this at half the price or below. Okay, that's what I'm thinking about this company. I think it's solid. I think it's fine. But look at this. I'd probably be interested in buying it somewhere here around this level, $30 level that it was in 2015. I wouldn't touch it at 73.18. So I think people are overpaying for the safety. I think they're overpaying for the survivability of the company. I think the dividend is fairly weak compared to other utility companies. I think the safety of the dividend is fine, but it's still quite a high payout ratio, which is not atypical for utility, but still. It's a very safe industry, that's for sure. I couldn't really, with a little bit of research, I couldn't necessarily find the exact breakdown, but what I can tell, a lot of the energy comes from natural gas, basically. They even go out in the markets and they trade natural gas in the open markets. They make profits from trading natural gas. But, they also sell to consumers, and but they also do burn coal, and they do nuclear as well, and all this kind of fancy stuff, but it's a much smaller portion of their production of energy than, I think, natural gas. But that's what I can tell. Correct me if I'm wrong on the percentages. If somebody's got the percentages, please share them with us so we can find out. But from the report, I couldn't really tell. It's not listed. maybe I need to go to the annual one and try to dig into those numbers there. So without any further um, major talking points, looking at the company's numbers and the fact that we don't really need to look at the news cycle, although there is some risk in this company in the news cycle because they do use coal and they have nuclear and whatnot, and sometimes regulators and the general public get a little bit of irritated with some of the energy providers, especially if the prices go high. There is some risk, so you got to discount that risk as well into the valuation, which could push the price of this thing even lower. Um, but in general, I like the company. I just don't like the price. I think 50% down from here is a reasonable price to buy this. Is a nice, income providing asset, and that would put the dividend at about 5% annually, which is reasonable. And on par with some of the bonds out there that you can get that have about similar safety, if not higher safety than this company. And that's my concluding thoughts. Let me know what you think about the company, whether you own it, why you own it, most of all, considering there are better options, or I think there are better options. Maybe there's something I'm missing. Let me know if there's something I'm missing, and so we can all learn from each other. All right, I'm going to end it right here. Buy at about half the price.